Hey there, everyone. My name is Ryan Schul. Welcome to my data science channel. So, a few days ago, I started a new series. This is all about training AI agents to analyze historical stock prices, and we use a few different strategies. This is my fourth video. I think there's about six total. I'm pretty sure it's six. And I'm training a bunch of AI agents to understand several different types of trading strategies and trying to get the AI agent to make trades that are um, basically performing well, right? We're trying to generate an above average rate of return on the money invested in this portfolio, right? So we're trying to train an agent to say, is this a good trade? Yes or no. Is this making profits for the portfolio? Yes or no. Is this losing money? Yes or no, right? If it's losing money, we will issue a punishment to the AI agent. If it's making money, we'll issue a reward to the AI agent, right? So this is the fourth of six videos, and all the videos kind of pretty much follow the same trajectory. Basically, just trying different investment strategies. That's basically the only difference here. And I tried to modularize everything. That's a fun word, by the way, isn't it? Modularize. Basically, to just containerize or take the code and to put it into different cells in my Jupyter Notebook environment, and then essentially um, pop in or pop out, or what do they call it? Interchangeable parts, where you can just drop in one cell and it's going to do everything that you need to do. There's basically three types of cells here: one that fetches the data, one that does all the training for the AI agent using reinforcement learning, okay, and then the last one's very simple. It just prints out the final results in a chart. So let me get into it. First of all, why would we even do this? There's a bunch of reasons. I have some notes here. You can read this. So I'm going to share all this code with you guys. So you can download this. This file is an HTML file, and then copy and paste that into your Jupyter environment, and then run everything in your own local environment there. So why would we do this? For data-driven decision making, we basically want to remove any kind of motion from the decision-making process and just get the computer to do all the work, and just say, okay, here's the trading strategy. This is what I want you to do. This is what I want you to learn. Learn as best you can. I'm going to issue rewards if you learn better, and punishment if you don't learn quite as well. And I want you to generate the best returns on this portfolio that you're capable of. Okay, so data-driven decision making, automation, speed, objective free and emotion free. I just mentioned that. Risk management, diversification, risk reward, and optimization, so on and so forth. Cost efficiency. You can read this at your leisure. So I'm going to go ahead and fetch some historical stock prices using these tickers. And by the way, you can add in any tickers that you want. That's what makes this pretty nice. Just add the ones that you're interested in analyzing, right? And I'm going to go back in time 36 months. So obviously this is 3 years. I think that's enough time to capture enough information to be able to make relevant um, and informative and timely decisions based on, is the strategy working? Is the strategy not working? And if it's working, then let's follow it, right? Let's follow the strategy and get the computer to make the trades for us. If it's not working, why is it not working, right? Try to figure it out and try to learn from that experience. So this is the first cell here. Just importing the data. I'm not going to run this. This part right here is actually pretty fast, but to run everything in its entirety, I mean, I could just run this one. This is quick. To run everything, to train the AI agent and to give it all the reinforcement learning stimulus that needs to be able to learn the operations here actually takes quite a while. It takes probably 15, maybe 20 minutes or so. So I'm not going to subject you to that whole thing. I'm just going to show you my notes, and then you can change the tickers right here, change the time frame. Okay, these are variables that you can control, and if you make the time longer or shorter, the outcome will be different. Okay, I don't know if it's going to be better or worse, but it's definitely going to be different. And if you pick different tickers over here, the results are going to be different too. Again, that's kind of subjective what you pick here. I'm just taking some of the Dow 30 components. It's probably like, was there 20 something tickers here, give or take? Okay, so here's the information, just importing everything and creating a correlation matrix. So the threshold for correlation is 0.80. If it's above 0.80, we're going to say that these stocks are highly correlated. And to do pairs trading, you really need two things. You need stocks that are at least 80% correlated, right? So lower correlation stocks really aren't going to work very well. If you follow the strategy, basically you're looking for stocks that normally trade together. We could say probably Apple and Microsoft would be a pairs trade, right? McDonald's and Burger King, something like this. Two companies that are kind of in the same business, similar business models. Basically, if one stock appreciates in value and one stock depreciates in value, but the fundamentals are essentially the same, and the companies operate very similar environments, similar outputs, then we could expect the one that's going up in value to probably depreciate over time, right? If these pairs are divergent, eventually they will converge, right? That's what we're looking for in the pairs trading. And so the one that's been going up, appreciating, will probably dip down and appreciate and return back to a price similar to the other pair, right? So if McDonald's is appreciating price, Burger King is depreciating, we would sell McDonald's, okay, because we're thinking that is going to fall and come back down to a price similar to where Burger King is, and Burger King's falling. We will buy that because we expect that to appreciate after a while and converge with the price of McDonald's. I mean, essentially, like it's going to be close, right? So we want it to be at least 0.80 correlation, and we want the pairs to be co-integrated. So if they diverge and they're correlated, that's great. But if they're not co-integrated, they don't move together, right? So we're looking for two things: correlation and co-integration. So if you find these stocks, we trade at them and hopefully make a lot of money. So moving down here, I have my correlation matrix, just plotting everything you saw up here. Okay, picture's worth 1,000 words. If you can visualize this, you can see all the results over here. And I have a plotly chart. I like these plotly charts a lot. It's dynamic, interactive. You can even zoom in and get greater details, and then double click and zoom out. And you have the what's it called? The bubble or mouse pop up over here that pops up. I forgot what that thing is called. Whatever. That little box, that little rectangle that pops up. That's nice too. So I like these plotly charts. I tend to use those a lot. So we're fetching the data, right? We're going to Yahoo API endpoint, pulling back all the data for these securities. There's maybe 15 or so. I didn't even bother to count them. And looking at the correlations of these stocks. Now we want to set up the pairs trading environment, and we're going to do a couple different things. If there's no real trading opportunity, we're just going to tell the AI agent to hold. We're not going to do anything. If it looks like a good opportunity to buy, like I said, Burger King's depreciating in price, and we expect it to appreciate because McDonald's is appreciating and that's getting higher. We'd expect that to depreciate, and again, they will converge. That's the expectation. Now, there's no guarantee that this is going to happen, but if it does happen, that's how you make your money, right? So go long on the pair has been depreciating in value. We expect that to appreciate eventually, and go short on the stock that has already appreciated. We would expect that to reconverge and follow a downward trajectory, right? So that is a strategy. That's what we're training the AI agent on. And here is all the logic. You can go through at your leisure and pick this out. I did a bunch of testing, so I think this is right. If somebody notices a mistake or an opportunity for improvement, please post that in the comments and I'll look into it. So this essentially takes $100,000 and says we're going to do two things. We're going to create a buy and hold portfolio and spread the $100,000 across all those tickers that you saw before, those 15 or so, and just spread it equally, right? So a ticker that is trading at a lower value will buy more shares of that with the 100,000 allocated equally, right? And if a stock ticker is selling at a higher price, we'll put the same amount behind that, and we'll just buy fewer shares of those, right? So we invest the same amount of money in all those tickers. The cheaper ones, we buy more shares, and the more expensive ones, we buy fewer shares. Okay, and then I'm going to go ahead and append everything into a data frame to be able to visualize the data frame, so I can see and say what's the buy and hold portfolio over time, over the 36 months that we're analyzing this, and we're looking at daily close prices, right? So every day the portfolio is going to be updated with the buy and hold market values updated, and the AI trading portfolio being updated. Again, in this case, this is a pairs trading. There's about 6 strategies that I'm looking at altogether, so you can check out all 6 videos. So this AI portfolio is focused on the pairs trade. So when this runs, we go ahead and get this nice little report over here. Okay, so the first pair is Apple and Microsoft, and the AI agent goes ahead and does the analysis and then spits out a nice little report. That's what takes about 15 or 20 minutes. That's why I'm not going to run this for you, because it's going to take quite a bit of time, and you can do that for yourself, but I don't want to subject you to that right now. But these rollout reports do a few things. They collect data for the training for the AI agent, right? So we have to train it and then test it and see how well it's performing. And the rollouts represent a bunch of different states or actions. This is how the AI agent learns, right? We have some performance metrics. The logs either we have average length, average forward, reward, frames per second. You can see all the details here. Okay, if you really get into it, this is great. This is how the AI agent learns, and this is very important. But we have to get into all the minutia of this thing right now. So I just have some more notes down here. You can read about that report and what it does. Here's the final result on the buy and hold portfolio. We start with 100K. AI portfolio, same thing. This is the trading date 3 years ago. So that is April 18, 2022. And it's, let's see, it's early March 5th, 2025. So this is going back in time 36 months. And we have the initial starting amount, 100,000 for both, right? The trade actions, the spread between the pairs, and then the daily P&L. This is profit and loss for the AI model. Now remember, the buy and hold, we just buy the securities 3 months ago and hold it. We don't do anything. So very simple, very straightforward strategy. We don't generate any taxes by buying and selling. We don't create a lot of stress for ourselves as a portfolio manager, right, or as the investor. Just buy and hold it for 36 months. That's it. Very simple, right? The AI portfolio is right next to that. And we log each one on a daily basis and get the final result. So you can see the buy and hold strategy created 144,361 at the end. We started with 100,000, so we made 44,361 in just about 3 years. So it's about what 100 and not 100, 10,000, maybe 13,000 per year, 14,000 per year, maybe 12,000 per year. So not bad, 12,000 per year for really doing nothing. We just sit on the portfolio and let it go. So the AI portfolio, this is very weird, but it is what it is, guys. I can't make this stuff up. 99,000. We actually lost about almost $300, $295 lost on the AI portfolio, even after doing all the analysis for the pairs, looking at the correlations, looking at the co-integrations, creating a lot of work, a lot of buy-sell transactions, a lot of tax consequences for each of these sell transactions and buy transactions, well, mostly for the sell. And we made no money, right? We made absolutely no money. Here's the plot to support the final conclusion here. So the AI portfolio is in red. We made no money after 3 years, and the buy and hold portfolio was profitable, making $44,000 in 36 months. So clearly the AI strategy did not pay off here. And I'm starting to see a trend that this is the fourth one that I'm looking at. This is the fourth strategy. You can check out the other videos. There's 3 more out there. This is number 4. I'm going to do 2 more. And I hate to break it to you guys, but the buy and hold so far in every scenario, the buy and hold really outperforms the AI strategy. Sometimes the AI technique gets kind of close. But in doing 6 of these, I haven't seen any where the AI strategy beats the buy and hold. So that's it. Sorry to break it to you, but I mean, that's kind of good news too, right? The simple strategy, the parsimonious strategy, what's it called? Occam's razor, right? Everything should be kept as simple as possible without oversimplifying something. The simpler strategy, just buy the thing, hold it, sit on it for 3 years, and then you make 44,000. Not a bad deal, right? So I just have a couple more things in my notes down here about pairs trading, market neutral strategy. You identify those different stocks that have high correlations, right? The correlation can be from -1 to +1. So do some research on that if you don't understand it. I do have a video on correlations and causation. You can take a look at that. That's very interesting. And we look at the co-integrations of those securities too, right? This is a statistical property that tests whether a combination or 2 or more non-stationary time series is basically, can be a lot of things. In this case, obviously, it's stock price movement over time. It can be sales. That can be a time series, weather patterns, customers' demand for our products. That can be a time series. Anything that's measured over a period of time can be handled in a time series analysis, right? So we look for things that are co-integrated or move together, and these things, again, it could be weather, it can be sales, it could be demand from our customers, or stock prices. So these are the 2 statistical metrics that we look at for the strategy. So that's it. The the time series, I'm sorry, the pairs trading did not outperform the buy and hold. And this is the fourth video I've done. And so far, the buy and hold strategy performs better than the AI strategy in every single instance. Now, if I made a mistake or if I could have done something better, please put it in the notes. I will revisit this. I've got 2 more videos to make about the other 2 investment strategies, and you can keep an eye out for that, and I will see you in the next video. Bye, guys.